Hello, dividend growth stock investors. Happy Sunday to you. Once again, it is Colby the DGI Crab coming at you with the 60 dividend growth stocks that this channel focuses on. We're going to go over those 60 and see where the value lies in the market so we can have a plan going into the upcoming week for investing. Now, why am I only focusing on 60 high-quality dividend growth stocks? Well, I only want to be buying the best of the best, the bluest of the blue when I'm buying individual single growth stocks, but I do want to buy them age appropriately when I can. So that's why I've taken those 60 stocks, split them into four smaller subsets or tiers based on the age and time horizon of the investor, which I believe is the most important metric for any dividend growth stock investor to take into consideration. You guys, I might be ignoring some value this week in favor of some blue chip quality. I have a lot of stocks that are in my personal top 10 favorite stock list. Stocks that I love so much, I will buy them at times, whether they look like they are cheap or not. Got enough of those that are looking reasonably priced. Not to mention, we're coming up on the ex-dividend date of a lot of those quarterly paying ETFs, those Vanguard funds, the Schwab funds. So I might be spending some extra money on ETFs this week and really hitting the blue chip stocks hard. But without further ado, I do want to just let you know I'm not a professional. Do your own due diligence before you invest your hard-earned money. My allocation strategy is as follows. If you're new, you might pause real quick and take a look. If you are not new and you've been here a while, you could fast forward past this, but I put half my money every week into age-appropriate ETFs, so I have automatic diversification for the individual single stocks if I'm buying them. For the most part, I'm looking for stocks yielding at least 30% or higher above their own 4-year average yield. Outside of that, I'm looking at my top 10 favorite stocks. I don't even really have a metric on those I'm paying that close of attention to. Sometimes I just add them. I don't do it every single week. It's not a dollar cost average thing. It's just a feeling thing on those top 10, if I'm being honest. Now, if I do see a stock in a different age tier that is yielding 50% or more above their 4-year average yield, to me, that's a green light to go ahead regardless of your age tier. If you feel comfortable adding that stock because you think it's a really strong turnaround play for the long term, go right ahead as far as I'm concerned. And then finally, if I don't see a buyable stock in my age tier, if I don't see anything that really gets me excited that particular week, I'm not going to invest less and just pile up cash on the sidelines. I'll just put more money into the ETFs for that particular week. So that way I can keep my dividend income momentum moving forward. So let's jump into it, you guys. I am going to start by looking at my personal top 10 favorite dividend growth stocks. These are the stocks that I think are worth investing in, almost regardless of what your age is, if they look like they are of a good value. Now, I am, as always, sorting by the valuation tab, where I am comparing that 4-year average dividend yield to the current day yield to see how far off those numbers are. Pepsi yielding, we'll call that 37% higher than their 4-year average yield. Pepsi yielding 4% or better is such a slam dunk for me, and I will look forward to adding it at above a 4% yield this week. I was adding it last week at a little bit under 4% yield, so uh, definitely Pepsi, you're welcome to stay down there in the low $140 a share to give me plenty of time to buy your shares up on the cheap. Now, of these 10 stocks, 7 of the 10 are actually yielding above their 4-year average yield. Not as high as Pepsi, but even all the way down here, Waste Management. I will be adding to Waste Management this week, you guys. I don't wait for Waste Management to yield 30% or more above its 4-year average. That just so seldomly, if ever, happens with Waste Management. And if I buy Waste Management at the quote unquote wrong time, then fine. That'll just give me an excuse to keep buying more of it to dollar cost average down if I get the timing wrong. Love Waste Management here. I'm locked in 100% adding to my Waste Management position this week. This is as low as the share price has been for several months now. Uh, No, I'm not getting an incredible bargain. I'm just getting a fair price. And in this case, I'll go with how Warren Buffett once put it. You don't want to get fair companies at great values. You want to get great companies at fair values. And to me, that's exactly what Waste Management is going into this week. I also really like Union Pacific this week, the largest railroad in the United States. They have the most tracks laid across this country compared to any other railroad. I think that their dividend is plenty safe, as well as their share price. They are yielding 2.5% right now. The 4-year average is 2.23%. That's about enough of a discount for me to continue to add to my ownership of the largest railroad in the United States. And then Procter and Gamble, another absolute monster of a company, monster of a stock. Procter and Gamble is definitely cheap enough for me to consider. It's not an amazing value, but the 4-year average yield of 2.43% is 11.5% lower than the current day yield of 2.71%. Good enough for me as far as Procter and Gamble's concerned. And right now, you guys, if you're trickling money into your McDonald's position, your Coca-Cola, even your Johnson and Johnson, I think Johnson and Johnson is maybe a little bit higher than I want to buy it right now, just because I've gotten used to buying it down at like 150 or lower because it's been there fairly recently. So I've got some recency bias there, but plenty of great value across the board here, you guys. Really, only Visa and Microsoft look to be way overpriced. Microsoft just came out with yet another dividend increase, keeping their streak alive, doing what they do. Even with their recent dividend increase, which I have factored in here to our formula, it's still overvalued. So let's break it down by the age tiers real quick, you guys. I spent a little more time on that top 10 tab because we want to talk about those blue chip stocks. I'm going to be adding to Waste Management and Union Pacific this week, no doubt about it. Procter and Gamble, I'm a little on the fence. We'll see how it goes, but that's just because Procter and Gamble's not in my personal age tier. So, we'll just kind of see. But here's the bigger list, you guys. So, tier 1, age 18 to 30. This is the lower yielding, 1 to 2% starting yield, high growth, 10% plus year over year growth. This is what we want out of this group of stocks. United Health, Nike, Nordson, these are the dogs in this category. I have consistently been adding to United Health and Nike for quite a while now because not only are they undervalued, they're yielding more than 50% above their 4-year average yield, making both of these very appealing. Now, Waste Management, you'll see my top 10 favorites there on these lists here, just in bold. Waste Management, right here at fair valued, but I'm going to go ahead, like I said, and add them this week. That's good enough for me. Tier 2, age 31 to 41-year-old investors. This group, we're looking more at like 2.5 to 3.5% starting yield with a 7 to 9% dividend growth rate. That's kind of the magic combo factor for me with this group. Target is one of the most undervalued stocks in all of the tiers, yielding comfortably above 5%. Target also just did a dividend increase recently. Very small one, just 8 cents a share, so a little less than 2%. I think we can expect those type of little dividend increases from Target probably for the next few years. Hopefully not the next 5 to 10, hopefully more like the next 2 or 3. But hopefully Target will eventually get back to doing double digit 10% or better dividend increases, which they certainly have had some history of doing that as well in their 50 plus consecutive years of growing that dividend. Buying Target with a starting yield this high above 5%, plenty enough money to pay me in the meantime to wait for the share price recovery. Kind of blown away Target's gotten down this low. I think they're getting punished a little bit too much. What do you guys think? And then in the meantime here, American States Water and McCormick and Company, two super dull, remarkably consistent dividend growth stocks. You guys, if you are a dividend growth stock investor, this is your style of investing, and you don't have American States Water or McCormick in your portfolio right now, do yourself a favor. Go research these two. I think you will see very quickly, looking at their dividend growth history, their consecutive streaks, all of that stuff. you'll quickly understand why these are on my list, and yielding up here in the high 2%. Great spot to get both of these because they're so consistent in giving high single digit dividend increases year over year consistently. And this is going to be the first week in a long time, you guys, that I haven't been buying Hershey. It's recovered up above $190 a share. Wow, the consecutive amount of weeks that I've been buying Hershey now has really been pretty wild. I've really built up a nice position in it. Happy to do so. I'd like to see Hershey recover back up to the point where it needs to be, which in my opinion is around like $210 a share or so. We'll just have to see how that progresses for them, but it's nice to see Hershey out of the buy zone for a little while. Starbucks and Next Era are close but not quite. And let's see here. And then I'm going to highlight here Union Pacific. I really like Union Pacific right here. It's more enticing of a buy for me right now than adding into Next Era or Starbucks currently. Tier 3, age 42 to 53. 3 to 4.5% starting yield type of plays here with good, solid, like 5-ish% dividend growth. Boring, stable, just stuff that you're adding to get you to financial freedom a little bit quicker without sacrificing dividend growth. That's really what this group is all about. And the type of stocks that generally are just the good, stable, boring backbone of a lot of dividend growth stock investors' portfolios. Stuff like the previously mentioned Procter and Gamble, Coca-Cola, Pepsi, Johnson and Johnson, ExxonMobil, household names, companies that aren't going anywhere anytime soon, and they're going to continue to pay out more and more dividends to shareholders as the years go on. Hormel Foods and Pepsi are the two obvious buys in this category for me. Hormel, I thought the floor for them was going to be $25 a share. Now they're inching down into the 24s. Makes me a little bit nervous, but I do think Hormel's dividend is safe. If management decides to cut the dividend and lose that dividend king status that they have, I'll be surprised. I've been surprised in the past on some companies that have made that decision. But it usually is pretty obvious that a dividend cut is coming. It's usually not something that just blindsides everyone. Hormel, the longer they stay down here in the mid 20s, the greater the chance a dividend cut could eventually come, and the less attractive the 4.67% starting yield is going to look. But I'm expecting another dividend increase from Hormel this year to continue their streak of dividend increases. I don't think it's going to be a big one, but I think they're going to keep that going. Tier 4, 54 and older investors, we want higher starting yield, not as much growth, but still some growth. 5% plus starting yield, 2 to 4% dividend growth rate. Still nothing in this category looks like an obvious purchase to me, so I'm just moving on if I'm in this group, and my investment breakdown would be as follows. Tier 1, half my money into ETFs. S&P 500, small cap value, dividend growth, and international. That's my allocation. Tier 2, same four, different weightings. Tier 3, slightly higher starting yield things in the ETFs like SCHD, VYM. Tier 4, higher starting yield and some monthly payers get in there as well. And things like high yield bonds, preferred shares, covered call ETFs. This is the best of the bunch in all those categories for my money. And then this is kind of where my priorities would be in each of the tiers. For tier 1, I'd be prioritizing United Health and Nike over anything else, but also looking at Waste Management and Pepsi. Tier 2, where I'm at right now, there's so many different places I could go with my money, anywhere from Target to American States Water to United Health to Waste Management. Lots of different places I can go. This is going to be probably a wide allocation week for a lot of things for me, and I'm just going to try to aggressively invest this week. Tier 3, a little bit fewer options. Pepsi and Hormel should be the priorities, and I'd be hitting Target even at age 54 and older because that starting yield is just so fat and juicy. Why not? Let me know what you guys are buying this week. Make a plan, acquire that yield at a good solid value, and build that passive income for your financial future.